What's going on, guys, and welcome back to another video. And today we are going to be analysing the payments technology company called Visa. And in order to do that, we're going to split the video up into three distinct segments, with the first of those being a historical financial review. Now, when I'm reviewing a company historically, there are 6 key metrics that I like to look for, and they are revenue growth, earnings growth being EBITDA and net income growth. I like to see free cash flow growth. I like to see a return on invested capital, which is greater than 10%. I like to see an interest cover, which is greater than 2, and I like to see shares outstanding either reducing or at least stable. Then, following the historical review, the second part of my analysis is going to be looking at future drivers of growth. So we're going to look at possible tailwinds for the business, as well as some headwinds that the business may be facing. And then lastly, we're going to look at what the valuation of the business is, according to my discounted cash flow and earnings multiple model. And then finally, if the stock gets a gold standard review on all 3 segments, so it has strong historical financial results, it has strong future drivers of growth, and the valuation looks good, then we consider whether this is something that we want to add to our portfolio. But just before we look into the historical financial review of the business, let's take a look at the high level overview. So we can see that Visa is currently trading at $217, and it has a 52-week high of just under $253 and a 52-week low of $193. So currently it's really trading at the midpoint between the high and the low over the last year. It has a short interest of only 1.3%, and that just goes to show that there aren't many people that are betting against this company, which is unsurprising considering if you look at the stock chart, this is a company that has just steadily compounded over time. When you look at the market cap, it has a total value at the moment of $458 billion. So clearly it's one of the larger companies within the S&P 500, and with a total enterprise value of $464 billion, which is greater than the market capitalization, which means that it's currently in a net debt position. So what does that mean? It just means that the company currently has more debt on the balance sheet than it holds in cash. Now that's generally not a bad thing in the current economic climate, considering how cheap debt is. So that's not something to be concerned about. So just flicking over to the financials, and metric number 1 is revenue growth. And we can see that we've gone from total revenues in 2016 of $15 billion, and that has steadily increased right the way up to $24 billion. And that represents around a 10% compounded annual growth rate. So this isn't a hyper growth company. It's fairly mature at this point, but 10% growth is strong nonetheless, and it's certainly a tick against that check mark. Now, there is one thing to note here, and that is that we did see a decline in revenues in FY20, and the reason for that is because of COVID-19. There were less people traveling, and we'll come to learn later on that Visa is actually highly dependent on there being a lot of cross-border transactions. Of course, because there was a pandemic and various restrictions on traveling and lockdowns, that wasn't happening so much. So they did see that decline in revenues, but that is really an anomaly, and we're not going to expect declines going forward. And then metric number 2 is earnings growth. So we can see here that we've got EBITDA and net income in blue and black respectively. Now, EBITDA started at 10.2 billion in 2016, and that has risen to 16 billion in 2021. So clearly, again, that is strong growth. Once again, we do see the decline in FY20, but that is driven by the fact that revenues had decreased because of the restrictions caused by COVID-19. So that is not an issue. Similarly, for net income, we've gone from 6 billion in FY16 right the way up to just over 12 billion in FY21. Now, the cool thing about this, right, is that net income has more than doubled in those 5 years, which shows that actually they have increased at a faster rate than what revenue has increased at. So revenue grew at around 10% compounded annual growth rate, whereas net income has grown at around 15% compounded annual growth rate, which shows that actually their margins are improving, or they have improved over time, which is always good to see. So margin expansion will generally lead to multiple expansion, which is what we've seen, which means that companies or institutions and investors will be willing to pay a higher multiple for this business, which of course drives up the share price. So very good to see there. And the metric number 3 is free cash flow growth. And again, similarly to net income, free cash flow has grown at a much faster rate than revenues, which shows that their margins are improving, which is always good to see. So we can see here that $2.12 in 2016 has increased right the way up to $6.82 in 2021. So again, it's a tick against that check mark, but also what I like to see is the fact that their margins are improving. This is a company now that is generating free cash flow at will, and I expect them to continue to do so. And the metric number 4 is return on invested capital. Now, this is a very important metric as it allows us investors to see how well the company is at producing a return, so net income, from the money that is invested into the business. I like to look for a return of at least 10% or greater, and we can see that Visa has no problems there. So we started at 18.7% and we're up to around 24% in FY21. We actually peaked at just under 28% or just over 27% in FY19, which is a ridiculously high number, right? It then did fall down and it looks like with somewhere between 20 and 24% is probably normal for this business. Now that is incredibly high. So when you start to see net income margins as high as 50%, which is what we're currently seeing for Visa, as well as return on invested capital of around 24%, straight away I'm starting to think that this is going to be a business where we have to pay a high premium for. But we'll come on to the valuation later in step 3. The metric number 5 is interest cover. So effectively this metric is looking at the amount of profit that a company is generating and whether that can cover the interest expense that they are incurring. And I like to see an interest cover greater than 2 because it goes to show that their profits are at least 2 times as high as the amount of interest that they're incurring. If it was less than 2, I'd be seriously concerned that they're not able to meet their interest payments in, say, a downturn in their business. So I wouldn't invest in a company that has an interest cover less than 2. 2 is the absolute minimum. Flicking over to Visa, we can see that it has always been greater than 20, so there's definitely no concerns there. It's currently sitting at around 31. So in other words, their profits are 31 times higher than their interest payments. Absolutely no concerns there from a balance sheet perspective. And the metric number 6 is total shares outstanding. Now I like to see total shares outstanding reducing, but at the very least stable. And the reason for that is if they are reducing, it means that the company is buying back shares and therefore giving me a greater proportion of ownership within the business. It's effectively a better way of distributing cash to shareholders than dividends because it's a more tax efficient way of doing so. We can see that for Visa, we've gone from total shares outstanding of 2.3 million as of 2016, right the way down to 2.1 million in 2020. So clearly it is decreasing over time. That's very good to see. It means that they are buying back their shares. So definitely a tick mark there. So I think it's safe to say that Visa has passed the historical financial review with flying colours. But let's see what the drivers of growth are going to be for the future. It's all good and well that they've performed well in the past, but ultimately markets are forward looking. We want to know how much cash flow the companies are going to generate for us in the future. And therefore it's important to know what the key drivers of growth are going to be. So let's get into that right now. And in order to do that, I want to divert your attention to the latest quarterly report and more specifically the comments made by Alfred Kelly, the chairman and the CEO. So we can see here that he said that our performance was driven by the continuation of the recovery in many global economies and the increased diversification of our revenue with new flows and value added services. So there were really 2 parts to that, right? With the first one being the recovery of global economies. So Visa is a company that relies on economies doing well because when economies do well, people spend more money. And when people spend more money, Visa takes a transaction, right? They take a transaction fee, a clip of every penny spent or every cent spent, right? So effectively, the more money that is spent in transactions, the more revenue that Visa gained. In order for more money to be spent, economies need to be doing well. So that is number 1. So effectively, a driver of growth is going to be, well, how well are businesses on generally how well is the economy performing? And then the second one is diversification of our revenue with new flows and value added services. Now, Visa is quite a mature business and it's rather difficult for a business like Visa to grow greater than sort of GDP organically. And the reason for that is because they pretty much dominate the payment space as it is. So it's Visa and MasterCard, and we'll get onto why that might be an issue later on. But effectively, because they already own so much of the payment space, it's difficult for them to grow even further, right? So effectively, their organic growth tends to fall in line with the growth of GDP. So GDP is gross domestic product, and effectively it's a measure of the total number of transactions, right? If GDP grows by around 3%, then so will Visa's revenue as well, organically. And then that's where this comes in, the diversification of our revenue with new flows and value added services. And generally speaking, what Visa are doing is that they are acquiring new businesses in order to come up with new flows and value added services. So they're very acquisitive and that's how they tend to grow their revenue. So we can see here, Alfred Kelly says that we're looking ahead, Visa is even better positioned for the future as cross-border travel recovers and we continue to drive the rapid growth of digital payments and enable innovation in money movement globally. So certainly in the short term, as the world opens up and travel increases again, they're expecting to make a larger amount of revenue through effectively cross-border transactions, so processing payments cross-border. So briefly coming on to the point that I was making, that Visa is a highly acquisitive business. So Visa has made 15 acquisitions and 48 investments. The company has spent over $29 billion for the acquisitions. Visa has invested in multiple sectors such as payments, banking tech, e-commerce enablers, and more. And we go to some of the latest enablers, so Currency Cloud, which was in July 2021, Tink in June 2021, so just a month between those two, and then Yellow Pepper in October 2020. And then when we come on to the price paid for these acquisitions, we can see that Tink was acquired for $2.1 billion and Currency Cloud was acquired for just shy of $1 billion. So this is a company that is going to have to pay money to acquire companies in order to grow. It will grow organically in line with GDP or slightly just above that, but generally speaking, a lot of its revenue drivers are actually going to come from acquisition. Now that in itself isn't an issue because they do generate such a significant amount of free cash flow, but you do have to rely on management getting the decisions right in terms of making those investments and at a good price. Now, historically, management have done very well with growing the company through these acquisitions, but it is something that you need to bear in mind. Now, one of the issues that can come alongside being a highly acquisitive business is that governments generally don't like to see it, right? And the reason for that is because they consider it to be anti-competitive and effectively they don't want to see monopolies in any particular industries. And so sometimes their acquisitions of companies can get blocked, right? So their acquisitions or their mergers can be blocked. And that is exactly what we saw just a few months ago in January 2021. So you can see here that Visa, fintech startup Plaid drop merger plans after DOJ antitrust lawsuit. So Visa and fintech startup Plaid ditched plans for a $5.3 billion merger on Tuesday after a Department of Justice antitrust lawsuit had threatened to block the deal. So in summary, Visa wanted to merge with Plaid, but in the end, they decided against it for no other reason than they didn't want to go through all of the regulatory hurdles that would be caused by the Department of Justice antitrust lawsuit, which had threatened to block the deal. So we can see here that the CEO said in a statement, he believes the companies would have prevailed in court, but protracted and complex litigation will likely take substantial time to fully resolve. In other words, he just didn't want the hassle of going through all of these regulatory hurdles just to make this acquisition. Now, this is a threat to Visa because if they can't make these acquisitions, their revenue growth is going to slow down. There is absolutely no doubt about that. Now, the problem with that as an investor is that it's really difficult to try and estimate what their revenue might be in the future if they cannot make these acquisitions, and what is the probability that they're unable to make these acquisitions, right? So we have no idea whether these future acquisitions will be blocked, and if so, how much of their revenue growth will then decline. So it's really difficult to try and put a value on that, but it is something that you need to be aware of. And then we can see that in April 2021, Visa was making the headlines again. So we can see here it reads, Visa MasterCard face biggest challenges in a decade. Regulatory, legislative and court confrontations over the card network company's fees are ratcheting up pressure again for reform of the behemoth's practices. So it reads here that Visa and MasterCard are still so dominant in the payments market that merchants couldn't stay in business without using their cards, noting US retailers and merchants paid a staggering $62.5 billion in swipe fees last year. All these costs are ultimately borne by consumers across America. So again, it comes back to the anti-competitive regulations, right? So effectively, it's very difficult for any other companies to come in and try and compete with Visa or MasterCard, and businesses have absolutely no choice but to pay these swipe fees. Now, I'm sort of torn between this, right? Because on the one hand, this gives Visa and MasterCard fantastic moats, and as an investor, that's what we are looking for. But on the other hand, it sort of poses a risk because in the future, if further sort of regulations are put on these businesses, then that is going to be harmful for the companies. So on one hand, it's great because they have a fantastic moat. On another hand, maybe their moat is a little bit too good, which means that they are going to be cranked down upon in the future. And then we come on to my valuation for the business. Now, I use a hybrid model between a discounted cash flow and an earnings multiple model to try and determine what the fair value of the business is today. So effectively, we can see here that I have gone for revenue growth in 2022 of 17% because that is what analysts are expecting. And then I've gone for 15% in 2023, so in year 2 of the discounted cash flow, because again, that is what analysts are expecting. So these two figures here of 17 and 15% growth in years 1 and 2 are what analysts are predicting. I've then gone for revenue growth to decline slightly to 12% for years 3 through to 5. Now, the reason we're seeing that decline is if we actually look on a historical basis, over the last 10 years, it has grown at an annual compounded growth rate of 10%, right? So 10% is what it has historically grown at for the last 5 years. And actually, when we look at the growth between 2019 and 2021, it was only 5%. So I wouldn't feel comfortable going with a continued growth rate of 15% for the following 3 years after that. I think that a proportion of this growth in 2022 is actually due to the fact that economies are reopening, and then clearly analysts are expecting that growth to sort of taper off. And again, I'm following suit with that, with a decline in the growth rate down to 12%, which is still greater than the growth rate that the company has seen historically. I'm then going for a growth rate of 8% from years 6 to 10. Gross margins are absolutely fantastic, so they are 97%, and that has remained consistent over the historical period. Operating expenses as a percentage of revenue similarly has remained very consistent, and that is at around 30%. Now for weighted average cost of capital, that is calculated within here, and that's at 8.2%. Cash and cash equivalents of 18.5 billion and debt of 21 billion. We've got a tax rate of 22%. So effectively what we are saying is that in 10 years time, we're expecting revenues to be $67 billion, which compared with the $24 billion in 2021 shows quite significant growth. When we go to profits, we're expecting profits to go from $12 billion in 2021 up to just under $34 billion in 2031. So over the 10 years, quite solid growth indeed. We'll then apply a multiple in 10 years time to this figure of $34 billion. So effectively, what will the PE be in 10 years time? And that is how we'll come up with our valuation for the business. We'll get onto that in a moment. Then coming on to discounted cash flow. I won't bore you with all of this, but effectively the EBITDA margins have historically been 69%, and unlevered free cash flow as a percentage of EBITDA has always been 71% on average, right? There is a greater amount of fluctuation there, but on average we're seeing 71%. And then effectively what I've done for my projected results is I've taken what the revenue is according to our forecast in the previous slide, and then effectively I've multiplied that by 69% to get what I believe the EBITDA will be within each of these years. And then similarly for unlevered free cash flow, I have taken 71% of that calculated EBITDA. And that is how we're projecting going into the future. So when we do all of that, right? So according to those inputs, so the discounted cash flow model is giving us an intrinsic value per share of $184, and the earnings multiple model is giving us an intrinsic value per share of $163. Now within that valuation, I've input an expected PE ratio in 10 years time of 22.5. Now that is rather high for a business that will only be growing, according to our inputs, revenues at 8% per year. But the reason why I've applied such a high multiple that when we look over the last 5 years, the average PE ratio has actually been 38, lows of 25 and highs of 52. So clearly this is a business that always trades at a premium. And the reason for that is not necessarily because it is such a high growing business, but because the margins of the business are actually so high. So 22.5, you could argue, is actually slightly on the low side. But the reason I've gone with a lower multiple in my valuation than what we see as the average here is because the business is slowing down in that growth. So effectively over the last 5 years, we saw that the compounded annual growth rate was around 10%, and we're expecting my growth to be around 8% going forward. Not only that, I do feel like there is an element of exuberance within Visa's valuation, which maybe isn't fair, right? So I understand that their margins are fantastic, right? This is, when you look at the margins of the business, they have 50% net income margins, they have significant return on invested capital, but I'm not sure that it warrants a 38 PE ratio if it was only growing at 8% per year, which is what I am personally forecasting in 10 years time from now. So 22.5. If I wanted to be very bullish, I would change that to 25 and we get an intrinsic value per share closer to what the DCF is telling us of $182. Either way, that gives us a fair value per share today of $183, which means that it's overvalued by about 15%. I think this is one of those perfect examples where just because a business is so financially strong, it doesn't necessarily mean that you can just pay any price for the business. And I think that the multiples that Visa is currently trading at is probably a little bit high, at least if you believe the inputs that I'm going for here. If you think that they can sort of grow their revenues at a greater rate, then maybe you'll be willing to pay a higher price. We're not really going to see much sort of margin expansion, right? We saw their gross margins, they're already at 97%. They can't increase those margins any further. Their operating expenses as a percentage of revenues are fairly consistent at 30%. So I find it hard to believe that their margins are going to improve any further as well. and therefore the only driver in adding value to the business is through revenue growth, which appears to be through acquisitions. Now, you may agree with me, you may not, but ultimately that's what the numbers are telling us. Anyway, that is what we think that the business is worth today. But what will the business be worth in 2025? So what is my 2025 price target for this business? So I'll zoom in a little bit here. Effectively, we are predicting for EBITDA in 2025 of $31 billion. And just to clarify, that EBITDA figure there is driven by the fact that according to our model, we're expecting $45.5 billion of revenue, and their EBITDA margins are relatively consistent at around 69%. So in 2025, EBITDA of $31 billion and an enterprise value to EBITDA multiple of 18. Now again, this is a business that has historically had very high multiples. So we can see over the last 5 years, the average enterprise value to EBITDA multiple was 25. We've seen lows of 18 or just under 18 and highs of 37. Now in 4 years time, I have to consider whether I believe that this exuberance towards Visa is going to remain. And effectively, I wouldn't feel comfortable with applying the average of 25. So if I apply a enterprise value to EBITDA multiple of 18, because the business at this point will then go into the slower growth phase of around 8% per year, I've only applied a multiple of 18. We'll consider what the difference will be if we apply a greater multiple in a moment. I've also incorporated into the model the fact that historically Visa have been buying back their shares at around 1.5% of total shares outstanding, and therefore I'm projecting that will continue right the way through to 2025. That gives us a 2025 price target of $282, which would be a compounded annual growth rate of around 6.5%. When you throw in the dividend yield as well of 0.7%, that gives you a total annual return of just 7.2%. Now, for me personally, that return is fairly low, and I probably wouldn't invest in Visa at these prices. However, the major difference between this method of valuation and the discounted cash flow is that the discounted cash flow doesn't care what somebody is going to pay for the business in the future. It's effectively saying this is how much cash that the business is going to generate, and that cash will ultimately be returned to the shareholders. So what is the value of that cash today? Whereas with this model, it's slightly more speculative in the sense that we are trying to predict what multiple an investor might be willing to pay in the future. Now, for me personally, I always like to be slightly more conservative, as that way I reduce the chance of me losing capital. And Warren Buffett's rule number 1 is don't lose money. And rule number 2 is don't forget number 1. So do not lose capital, and that's why I try to be conservative. If you want to be slightly more bullish, you can increase the enterprise value to EBITDA multiple. If you believe that an investor in 4 years' time will be willing to pay these multiples, then again, let's increase it to 20. And we can see a compounded annual growth rate at that point of 9.1%. The problem I have there is that it's still below the general S&P 500, or it's more or less in line with what the S&P 500 has returned over any sort of 10-year period. And therefore, again, what is the point of taking on that additional risk of investing in only one company when you can get the same return from a diversified portfolio of 500 companies? If, however, you wanted to take it one step further and say that I believe that an investor in 4 years' time is going to be willing to pay a 25 multiple, which has been the historical average over the last 5 years, well, then you get a return of 15%. And that would actually be a total annual return of 15.8%. But I personally wouldn't be comfortable with hedging my bets that investors in 4 years' time are going to be as bullish and the market is going to be as exuberant as it has been over the last 5 years, right? So you have to remember that the last 5 years, we have been living in a bull market, and one of the greatest bull markets that we've ever seen, right? So is it sensible to assume that actually the markets are going to continue in that fashion, and investors in 4 years' time are still going to want to pay 25 times EBITDA for this company? And bearing in mind that the company at that point will only be growing, according to our model, at around 8% per year. I don't know, that's for you to decide. And then when we flick across to the charts, we can see that over the last year, so from November 2020, we can see that Visa has pretty much traded between sort of $208 and around $233. And it's largely stayed within that range. So the level of support at around $208 does seem pretty strong. And actually, it looked like it was going to break that mark just a couple of days ago. And then it bounced back up to $216 following that. However, if we do see a breakdown below $208, there's a chance, I believe, that this falls down to around $183 over the next few months if we do see that. And at which point, that would hit my fair value estimate for the business and at which point I would think that this would be a great acquisition just because of how solid the foundations are for this company. But at this sort of marker around $213, $215, I still don't think it's quite low enough to justify an investment for me personally. Anyway guys, I hope you've enjoyed the video, and until next time, thank you.